Hey guys, welcome back to my YouTube channel, and today is going to be the first video of what I have decided will be 100 videos on personal finance. So let's jump in. Okay, so this video is going to be about index funds, mutual funds, and ETFs. What are they? What are the differences between them? Is this important information for you to know? I consider myself a beginner investor, so hopefully this information will help others who are also beginner investors learn more about different financial products and what they can do for them. So before we continue, let's encourage you to hit the subscribe button. If you want to learn about personal finance with me, I'm going on an 100 video journey, and I encourage you to come with me, learn about personal finance. It might help you in the long term. You might be really grateful that you dedicated this time to learn these things. My channel is about self-development and personal finance, so at least that's what I'm thinking right now as I'm getting started, and you should definitely hop on board and get learning with me. So yeah. The first financial product that we're going to talk about is mutual funds, and I decided to start with mutual funds because they were invented first. They were the first of index funds and ETFs. Mutual funds, they came first. So a mutual fund is a way for a group of people to pool all of their money and investments together. So I'm guessing originally it probably started with like wealthier people who wanted to share the same investment portfolio. So the first mutual fund was actually started in the 1800s, so that was a really long time ago. But let's talk about the advantages and disadvantages of a mutual fund. The first advantage of a mutual fund is that they are simple. So you can own a bunch of stocks in one easy package. So a mutual fund can have hundreds of stocks in it or more, and it's much easier to purchase into a mutual fund than to buy 100 separate stocks all by themselves. So to achieve this level of diversification on your own, you would have to buy those 100 stocks individually, or whatever number it is separately. But with a mutual fund, you can buy a share of the mutual fund, and whoever is managing that fund will ensure that that money is spread over the 100 stocks or whatever that are in that mutual fund. Another great benefit about mutual funds is diversification. So what does that mean? This is like one of the core principles of investing. The idea here is that if you buy only one stock and that stock doesn't do so well that year, you're kind of screwed, because if that stock goes down and then, the company goes bankrupt, you've lost all your money. But if you buy 100 stocks and 2 or 3 of them or a handful of them don't do well, then the other stocks that you've also purchased are going to balance that out and help you gain returns in the long run as an average of all the stocks that you own. So mutual funds are great for diversification because by buying one share of a mutual fund, you're buying many different stocks, and so they're going to have good diversity. So another advantage of a mutual fund is that they have professional management. So every mutual fund has a mutual fund portfolio manager. So they're typically managed by a financial professional, someone who probably knows more than the average person about stocks and investing. And so instead of using some brokerage app by yourself and choosing 100 stocks that you think are cool, you have a financial professional who's managing your money, who's saying these are the best stocks to own on the whole. So what are some of the disadvantages of a mutual fund? The main disadvantage of a mutual fund is the management fee, because anybody who's managing a fund, they're going to take a proportion of your total portfolio every single year. And that percentage usually ranges from 1% to 2%. So if you think about that over time, that can really dig into your nest egg in the long term. And then again, I think the idea here is that most mutual funds will give you more returns than the fees that they're charging. So it might weigh out in the end. Like, you might be making really great investments, your fund manager is picking a great portfolio for you, and so you might be willing to pay that fee. But a lot of people see that management fee as the overall worse drawback of a mutual fund. So just keep that in mind, and there are other options that have lower fees. The main other option that has a lower fee is actually an index fund. And what is an index fund, you might ask? So this dude named Jack Vogel, he was the guy who started the first index fund. And he actually was just annoyed because he felt like mutual funds were ripping people off, charging a high management fee. So he actually started the first index fund as a response to his frustration with mutual funds. So the first advantage of an index fund is that it has a passive management structure. So this type of fund follows a formula so that it doesn't have to be actively managed. This formula is based upon an index. What is an index, you might ask? An index is a representative sample of the stock market. So this means it's like a summary of how the overall market is doing. So have you ever heard of the Dow Jones Index or the S&P 500? These are like cryptic terms that I just figured out what they meant. Or the FTSE, the FTSE 100. This is like another index. So indexes are a group of companies that are chosen by like somebody, but it's not like a fund manager. It's just kind of like a general financial term. And this group of companies comprises the index. So example, the S&P 500 is a group of like some of America's 500 like top performing companies, or companies that someone thinks is indicative of the overall health of the American economy. And so an index tells you like how well or how poorly like an economy is doing, like as an average kind of. So let's say there was an index fund based on the S&P 500. That means your money is getting put in those 500 companies that are part of the S&P 500. So the stocks in that portfolio are not handpicked by a manager, but they follow a certain index. And you can get an index fund that follows any of the indexes that you like, any of them of their choice. Like S&P 500 is an American index, the Dow Jones is an American index, the FTSE 100 is the 100 largest companies in the United Kingdom. So in the 1970s, Jack Bogle started an index fund that mirrored the S&P 500. So if you want to invest in an index fund, you just choose whatever index appeals to you, and then you go on some brokerage app and you find an index fund that is representative of that index, and you invest, and then your money will be diversified among all the companies in that index. So diversification is one of the main advantages of an index fund, just like of a mutual fund. And the third advantage of an index fund is lower fees. So since an index fund simply buys whatever stocks are in a given index, the fees are much lower than they are for a mutual fund. So the typical fee for an index fund, I believe, is about like 0.04%. So that's a lot lower than 1% or 2%. And that really, really adds up over time, like 0.04. So that's like nothing, basically, like a very, very small percentage of your portfolio. And then the fourth advantage of an index fund is going to be automatic reinvestment. So you can set like a recurring monthly deposit from your checking account into your index fund, and then that money is automatically invested for you. And this is at no extra charge to you, so it's free, so that's really awesome and a great way to establish healthy investing habits. So then in summary, all index funds are mutual funds, but not all mutual funds are index funds. So all index funds will invest your money in a lot of different companies at once, which is kind of the idea of a mutual fund, but not all mutual funds follow an index. Some mutual funds are just, someone's choosing your portfolio for you and they're managed by a human. Okay, let's move on to exchange traded funds. Yay! Okay, so exchange traded funds, or ETFs, were introduced about 15 years after the first index fund. So they're very similar to index funds, except there's only one difference. So an index fund, you have to buy and sell your shares only once per day, while an exchange traded fund trades like a stock. So whenever the stock market is open, you can trade an exchange traded fund. So honestly, from the average investor's perspective, there's not really a big difference between an ETF and an index fund, because most people just buy into the stock market and then hold their money until retirement, and then they use it, So you don't really need to be able to trade and buy and sell your index fund at like all hours of the day. But anyway, that's what an ETF lets you do, so that's the difference. The other difference between an ETF and an index fund is that an ETF does not actually offer the automatic reinvestment that an index fund does. So that's kind of a problem. And so actually I think index funds are like the best option between ETFs and index funds. But just know that if you want to be automatically investing your money and have the index fund reinvest your money, then an ETF is not a good option for you because you have to physically buy and sell your own shares with an ETF. So thank you for watching. Hopefully you've learned something about these different financial products and options for investment. If you have any questions, please drop them below in the comments. If there's anything you want to learn about that's finance related, also leave that in the comments, or like DM me on Instagram or like whatever. Happy to make videos on anything that comes up. If you're new to the channel, subscribe for more videos. Go on this finance journey with me. Also, definitely smash that like button because it helps with the YouTube algorithm, and it's just a great thing to do. You should definitely smash that like button. You can also find me on Instagram. My handle actually changes a lot because I just change it a lot. So just type in Ingrid Zip, like that's my name, and I'm actually like the only Ingrid Zip in the world, so you'll probably find me that way. Yep, so that's it. That's the difference between mutual funds, index funds, and ETFs, and I hope that made sense. I really do. I hope it made sense. So yeah, see you guys next time, and thanks for being a part of my YouTube channel. Okay, bye.